Well, you're still with me, and we've got to lecture number 8, money. And today we're going to be talking about bank accounts and all sorts of things that relate to money and business and so on. I hope you'll find some of this informative and some of the things that I'm going to tell you perhaps you've never heard of before. All right, there are different kinds of bank accounts. Let's start with that. So you've got things like a current account, you've got deposit accounts, you've got things like debit cards and credit cards, all different kinds of banking. A current account usually gives you a checkbook and usually a debit card. We'll explain debit and credit in a little later on. But these days, actually, people aren't using checks quite so much. In fact, I was recently in Norway and I pulled out my checkbook to pay something to somebody, and my friend said to me, "Oh, let me show my daughter this. She's never seen a checkbook before." I said, "What do you mean never seen a checkbook before?" He said, "We haven't used them in Norway for about 5 or 6 years because everything is done by phone or bank to bank or by computer, and we no longer use checks." And even in the UK, cheques are becoming useful less and less as people pay bank to bank via their computer or nowadays by their smartphone. When you do that, of course, money is electronically transferred from your bank account to another bank account or to pay a bill or something like that. And it's actually very easy once you get into it. Let's have a look at the different types of deposit accounts. And you can see a little chart there. Deposit accounts vary. There are types of deposit accounts which the banks will talk about and call them instant access accounts, which means that you've got your deposit, you can go into the bank and draw the money straight out. You won't get a checkbook or anything like that. It's just over the counter. And these days they won't even give you a book to record it in. It's all done on the screen or in the bank, and you need to look at your computer to see how much money you've got in your deposit account. And then when you go in, you just say, "Please, can I have," and this is who I am, and you have to prove who you are, and you can take your money out. There are savings accounts, which usually you're putting your money in regularly, and so you're saving that money, and usually will often pay a little bit more interest than an ordinary deposit account. And then there are what's called fixed time deposit accounts. In other words, you're depositing the money, and sometimes for a year or 2 years, and you cannot go into the bank and say, "Please, can I pull my money out of my fixed time account?" Because no, you can't. It's there for 2 years. That kind of account is worth using if you don't need that money for a couple of years, because it usually pays you quite a bit more interest than an ordinary deposit account. But as I've said, with a deposit account, you don't get a checkbook or any cards. It's just you're putting money in the bank and they're paying you interest for depositing it there. I want to talk now about something that maybe you've never heard of. Perhaps you have, I hope you have, and that's a thing called credit unions. In some ways, a credit union and a bank are just the same thing. They both allow you to open checking or savings account, and customers can apply for credit cards and loans depending on the size of the credit union. But when it comes to how the two operate, the differences are absolutely stark. Have a look at this. Banks are for-profit corporations. Credit unions are not-profit organisations. Shareholders own banks. Members own credit unions. Anyone can open a bank account. With a credit union, members of a credit union share a common bond. They might be a living bond, or working together, or worshipping together, or attending the same school, or living in the same area. What these differences mean is that both banks and credit unions do make profits. They do this in a combination of two ways. They charge interest on loans and credit cards, and they invest in mutual funds of government bonds that earn money when the holdings perform well on the market. The difference is who benefits from these profits. Banks, as we've said, are for profit. Corporations run by a board of directors. They use customers' deposit to earn the most money possible, and the profits go to the shareholders who purchase stock in the bank. What is stock? Well, stock is what you buy on the market, shares. That's what stock is. Credit unions, on the other hand, are not for profit. They're often run by volunteers who don't get paid. That's their board of directors. Their purpose is to serve the members. When you join a credit union, you become a member and thereby are entitled to profits in the form of higher savings rates, lower interest rates on low-cost services. So oftentimes, if you're wanting to go to a credit union, you're a member of a credit union, they'll lend you money at a lower interest than a bank will. There's other differences as well between a credit union and a bank. A credit union, as I've said, it's like a bank, but usually there's no checkbooks or bank cards. It's a union of like people. It could be a church, or it could be a company or a neighbourhood. And recently, the largest credit union reported in terms of how much deposit money was actually in the credit union was, funnily enough, the London Taxi Drivers Credit Union. They had the most money. The advantage of a credit union is they will often lend you money when a bank will say, no, we can't. They will often also lend small amounts of money and charge very low rates of interest. The idea behind a credit union is that probably the members tend to know each other. And if you know each other, you are psychologically less likely to default on your repayments of your loan, because it's not some faceless thing. It's your friends' money. It's your friends that are part of that credit union. The government actually insures credit unions and even provides free training for its officers, who, as I've already said, are normally volunteers. Often, the idea of the government insurance, of course, is if you do get somebody dishonest that runs away with the credit union money, the government has got an insurance policy in place for that. But actually, with credit unions, that very rarely happens. Credit unions are community orientated. And as I've said, you must be part of a group that has a general interest in itself. So your local area might have a credit union. I know that my local borough has a credit union, and something like I've already mentioned, the London Taxi Drivers has a credit union. A church could have a credit union. A mosque could have a credit union, and they would benefit the people who are part and parcel of that community. It doesn't have shareholders. When you go to a bank, what happens really these days is you want to borrow some money, and that request is fed through to a computer. So it's actually nobody really sitting there. The computer really is looking at all your facts and figures and all your loans and all the things that you've got as a person, and have you ever been in debt, and where do you live, and all those kind of things. And then the computer decides, not a person, yes, we'll lend you money, or no, we won't. But with a credit union, it's much more personalised, and the representative tends to review, why do you want this loan? What's your situation? Are you likely to repay it? And what is your current financial situation? So it's a much more personalised thing. And of course, credit unions are usually smaller than the big banks. Okay, enough of credit unions. Let's look at another area of finance. Investment account. Investment accounts are usually linked to the stock market, and you're putting money in and buying stocks and shares, and sometimes this is done for you. There are all sorts of areas where you can invest money, and somebody else is doing it for you and paying you the interest, and you're just receiving it at the end. What are you buying when you buy stocks and shares? Well, you're actually buying a little bit of a company, whether it's a public company or an ordinary limited company. You actually become the owner of a tiny percentage of that company. So if you buy one share, you're 1% owner of that 100% of that company, which is very, very tiny, of course. Here's something that perhaps you've never heard of. It's a thing called the overnight money market. What on earth is that? Well, big companies that are making lots of cash in a day, they usually employ one special person whose job is at the end of the trading day to take all the money left over in the company's coffers and put it on the overnight money market. Now, believe it or not, money is being used while we're all in bed asleep, and that money earns interest overnight. The next morning, that overnight money market manager will go into the company and he will take all the money back out of the overnight money market plus any of the interest that it's earned. Probably not going to affect lots of us, but I'd just like you to know that that is one of the areas that's going on within the world of finance. Another area to talk about is ISAs. What is an ISA? Well, I've got some things there that actually aren't ISAs, but you can look at those. ISA. It's funny how we use these little phrases, isn't it? And we don't always know what they mean. Well, what does ISA stand for? It actually stands for an individual savings account. And it's set up by the government. You usually do it through the banks. It's a way of saving money, but it's a way of saving money that earns you slightly more interest and you don't pay tax on it. So even though you're earning that interest, you remember some time ago I told you that even your deposit account at the bank, you will pay tax on any interest earned if you're due to. Whereas with an ISA, the government says, no, we won't allow you to pay tax on that. But there is a but. You are actually only allowed to put a certain amount of money into that deposit account in a year. I'm not sure what the actual amount is at the moment, and the government from time to time varies it. I think it's about £5,000 a year. So if you've got a spare 5,000, you can put it in your ISA. It will earn more interest, and the government won't charge you any tax on the interest that you earn. And it often pays better interest than a normal deposit account or savings account with a bank, although it'll be handled by the bank. Really, what's really happening with an ISA is that money is being invested in the stock market or in ways that are earning more interest for your account. So that's what's really happening with the money behind the scene, but you're probably not worried about that. You're just worried about how much interest you've earned over the year. Here's another funny financial area that is very old, actually. EARNI. Anybody know what EARNI stands for? It's like an ISA. It's another acronym. What does it mean? Well, it's very old, and it stands for Electronic Random Number Indicator Equipment. I think it was invented before the real computer age, because what it was a great big machine. Now, how EARNI works is done through the post office. You can deposit money in EARNI. What you're really doing is buying what's called a premium bond, and you put your pound in, or your £10, and you buy £10 worth of premium bonds. Now, here's the catch with EARNI. During the time that the money is deposited in EARNI, in a premium bond, you actually earn no interest whatsoever. However, once a month, EARNI runs its computer and all sorts of numbers come up, and each premium bond has a number, and if your number comes up, you get £1 million. So that would be very nice, wouldn't it? Of course, there's lots of people buying premium bonds. You never lose your money. In other words, if you bank £10 in premium bonds, you've always got that £10 and you can draw it out again. But you are losing something. What you're losing is interest. Now, think about that. Okay, maybe they're only paying 1.5% in your bank account. That's 1.5%. But inflation is also taking place, and at the moment in Britain, inflation is running around about 2%. So you're losing 1.5% interest, and you're losing 2% per year. in terms of inflation. So the £10 that you've banked is actually becoming worth less than when you first banked it. That's how the premium bond or the post office or who's handling it is actually making their money. Okay, so much for Ernie. Now let's have a look a little bit more about banks. There's lots of them. Well, there isn't really, but there are quite a few. Lloyds, Barclays. Some banks these days are calling themselves ethical banks. And actually, I bank and our company banks with one of those ethical banks. It's actually something that you've probably never ever heard of because you won't see many on the high street. It's a bank called Triodos. They only have one branch at the moment. That branch is in Bristol, although you can use other banks to put your money in and lots of different ways. We bank with them. The Co-op Bank, which does have branches all over the place, it originally began as an ethical bank, but because of bad management, recently it's stopped being a bank that's so ethical. A little bit more about Triodos. This bank started in 1974 and it was called the Mercury Bank. And I actually met those people from the Mercury Bank in 1974. It was later taken over by Triodos, which is actually a Dutch bank. And so you'll see at the end of their name, Triodos Bank NV. And you go, what on earth does NV stand for? Well, it's the Dutch equivalent. When you see on the high street, LTD, Limited, NV is the Dutch version of Limited. And Triodos now operates in the UK, it operates in Holland, and it operates in Germany. But unlike an ordinary bank, and I know from experience when you want to borrow money from Triodos and say I need this much money, they don't just want to see your cash flow and your business plan, but they say please show us how this is going to benefit your community. What are the community benefits? So they're looking at 3 areas rather than just 2. If you go to an ordinary bank, they just want to see your cash flow and your business plan. Are you going to make a profit? Triodos want to know, are you going to make a profit? Where's your cash flow? And how is the community benefited? I like that kind of approach. Long ago, I remember talking to my local bank, which was the NatWest, and I said I wanted to borrow a large amount of money and this is the way I would finance it. And I would do a thing which is called cross guarantees. The NatWest Bank listened to me very carefully, at least the manager did, and he said, you've got the right idea, you're absolutely correct in your financial thinking. However, because what you want to do is too difficult for a big bank to administer, we can't do it. When I talked to Triodos, they said, oh, we work like that all the time. In fact, going back to credit unions, some of the systems that the credit unions use are very similar to what I was suggesting to NatWest all those years ago. If you want to borrow some money and to know all about cross guarantee, you'll have to write to me and I'll explain it in more detail because it's quite complicated, but it's actually a very clever way of borrowing money. It's interesting to understand how some of our banks started, going right back, of course, to those gold merchants who were using their safes and loaning them out and so on. That was the beginning of banks. But big banks like Barclays and Lloyds, that was an interesting reason why they started. They were started by what was called nonconformists. For many years, if a person was not part of the Church of England, they would not be allowed to enter into law, education or other professions. This also applied to the Jewish community. Remember what I said about Jewish laws and lending? Therefore, the only thing that one could do is to set up one's own company, be it a financial company like a bank, or maybe a chocolate company making things like Cadbury's chocolates or Rowntree's. They were all set up by nonconformist Christians or Quakers because they were not allowed to enter any other kind of business. Now, I lived round the corner from Cadbury's for many years, and I found some of this thing and their financial understanding and the way they work very, very interesting. Their values can still be seen today, although I have to say that much of the original ethos has been eroded as they were taken over by other companies. If you know anything about what's happened in the UK recently, Cadbury's is part of a much bigger group based actually in the USA. But their original way of working was very innovative. It was very different. And often this gets forgotten. I know that atheists and humanists love to say that non-Christian people did good things too. Right. However, I would like to hear all their examples. But what I do know is about the Cadbury's example because I live very closely to it. Cadbury's built a housing estate in a garden. In those days, when Cadbury's really started in the 1800s, working people lived in very bad conditions. And Cadbury's, when they wanted to start their big chocolate factory, said, we don't want our workers to live in bad conditions. We want them to live in nice places, nice houses. And so they came up with the idea of let's build a factory in a garden. Cadbury's, of course, was started by Quakers. They were nonconformists. Another thing that Cadbury's did that was innovative is they put directors on the board who were just ordinary working people in the factory. Now, we're just talking about this in 2017. The government is saying that maybe this is a good idea. Cadbury's did that kind of thing in the 1800s. Here's a picture of the housing in a garden, and actually that's going back to the 1800s. I lived around the corner from there, and it still looks like that today. One of the funny idiosyncrasies of Cadbury's and Bourneville, that what you're looking at is the Bourneville estate in Birmingham, in the Midlands, in the UK. One of the funny things is that because the Quakers were teetotal, in other words, they didn't drink alcohol at all, they made a law for that estate that you couldn't sell alcohol. Recently, the big supermarket Tesco wanted to open a supermarket inside Bourneville estate, and Cadbury said, yes, of course you can do that, and you can open a Tesco's, but you will not allow to be selling alcohol. I was recently in the area, and I noticed that Tesco's have built a big Tesco stores right on the edge of Bourneville because they weren't allowed to build it in the estate because they were going to sell alcohol. Bourneville, the factory in a garden. The the whole thing was really interesting in the way that it started. Cadbury started by selling coffee and tea, but eventually started selling hot chocolate. In those days, in the 1800s, there was no such thing as a bar of chocolate. You could only drink it, you couldn't eat it. Let's read this. As a nonconformist, Quakers were barred from the major universities and thus from professions such as medicine and law. Nor as pacifists, that means they didn't go to war, could they consider naval or military careers. English Quaker businessman George Cadbury leaves an amazing legacy. So they became big trading people. And being teetotal, they were keen to promote any alternatives to alcohol at the time when a single cup of municipal drinking water could prove lethal. That's why alcohol really became such a big thing, because if you drank the drinking water, it probably would have killed you. In 1824, John Cadbury, then aged 23, opened a tea shop and a coffee shop next door to his father's drapery shop in Bull Street, that's in Birmingham. He branched out into cocoa, grinding coffee beans himself, and by 1831 the shop was devoted entirely to drinking chocolate. It was not, as I've said already, for eating in those days. By the 1850s he had a royal warrant from Queen Victoria, and in 1860 his sons George and Richard imported a Dutch chocolate press, so now they could separate the cocoa liquid from the cocoa butter and create what we would nowadays recognise as a bar of chocolate. Just for fun, my little story about Cadbury's is when I was 13 and 14, I used to deliver papers in Birmingham to earn some money. And I was fortunate enough to deliver them in a very expensive road in Birmingham called Chantry Road. It was the only road I know of, and still it's the only road I know of, that has a private park. And if you lived in that road, you were given a key to the park. And a lady lived there by the name of Mrs. Alexander Dixon. And one day she invited the paper boy to come for tea. The paper boy was me. And I discovered while eating my tea, jam and bread and drinking chocolate that Mrs. Dixon was originally Mrs. Alexandra Cadbury. She began to talk to me about the Bible and told me that she was not only part of the Cadbury family, but she had founded another organisation called the PTL, the Pocket Testament League, and was trying to persuade all young people like the paper boy to carry a New Testament in their pocket, which she gave me a free one with the PTL logo on the front. Enough of my story. Let's talk about fractional reserve banking, and we've talked about that quite a bit during these lectures. Fractional reserve banking is the practice whereby a bank accepts deposit, makes loans or investment, and holds reserves equal to a fraction of its deposit liabilities. Think about that for a minute. So you put your £10 in, as only 10% of that is saved, and the rest of that can be relent to somebody else. Reserves are held as currency in the bank or as balances in the bank's account at the central bank. Fractional reserve banking is the current form of banking practiced in most countries worldwide. Here's an illustration of how it actually works. You remember those going right back to the beginning, to those gold merchants with their safes? Piece of paper, a receipt. You're lending first of all against a piece of gold that exists. Then you're lending a piece of paper against gold that is in your safe but doesn't really belong to you. And then you're lending just a piece of paper against which there is no gold backing it. Okay? Got the idea? And the gold merchants had discovered that only 10% was ever fetched from their only 10% of the gold was ever got back from the safe. So the banks lend more money than they really have. That's what fractional reserve banking is all about. Okay, can you read that? What happens when everybody comes and wants their money back? It's called a run on the bank. Actually, if you look at history, this happened an awful lot in the USA because they had different currencies and different banks, and oftentimes there'd be a run on the bank and the bank would go bust. So, as I said to you earlier on in some of the previous lectures, if one of those gold merchants had suddenly had somebody coming for all the gold that was in their safe with the right receipts, they really would have got beaten up, wouldn't they? So here's the cycle of fractional reserve lending. Just have a look at that little chart there. So right at the end, from your first deposit of £1,000, the bank now has £3,439 which they can lend, but actually they've only got £729 in the bank. Does that make sense? Now, the question I ask is, what happens when everybody wants their money out? We've seen the answer to this question in 2007 in the United Kingdom, Northern Rock, and of course there were branches in London as well. It was a huge rush. That's a picture, an actual picture of what was actually happening with the Northern Rock. Everybody trying to get their money out. They reckon on one Friday alone, people withdrew their money from the Northern Rock bank, £1 billion was taken out in one day. And of course, the banks don't have that kind of liquidity. Liquidity means cash that you could just give out. Okay? Frightening. And eventually, of course, the bank collapsed and was sold over, and the government had to step in and rescue the banks. And it's all history which you can check out. Okay, let's have a look at credit and debit cards. If you've got a credit card, you can actually spend money that you haven't got. And if you pay that money back at the end of the month, usually the nice credit card company will allow you to do that for free and they won't charge you any interest. But if you don't pay it all back, they start to charge you interest on the amount of money that you haven't paid back over the next month. And usually a credit card will have what's called a credit limit. Some people call it revolving craft. So you can use those credit cards over and over again, and you're revolving the money, really. Some of it obviously isn't yours. Now, what's the difference between a credit card and a debit card? Well, a debit card really is just a piece of plastic, and unlike a credit card, it's actually your money. So when you use a credit card, you're using the bank's money. When you use a debit card, you're using your money. So the money is coming out of your account. And if the money isn't in your account, because of our technology nowadays, it's always instant, the credit card won't work. So if you go and you've not got any money in the account and you try and buy something with a debit card, it will not work. So you cannot spend what you have not got. So in a way, using a debit card is just the same as using currency. It's your money. It's not in your pocket as cash. It's in the bank. But if it's not there, it won't work. Okay, have a nice day.